Depreciation is a critical concept in accounting that allows companies to allocate the cost of tangible fixed assets over their useful life. There are various methods for calculating depreciation, each of which can significantly impact a company's financial statements. Choosing the right depreciation method is essential for businesses to ensure accurate reporting, tax compliance, and optimal financial performance. In this video, we'll explore the top 10 differences between commonly used depreciation methods and how they affect financials such as income statements, balance sheets, and cash flow. 1. Straight line versus accelerated depreciation. The straight line depreciation (SLD) method is the most straightforward, where the same depreciation expense is allocated each year over the asset's useful life. On the other hand, accelerated depreciation methods, such as double declining balance (DDB), and sum of the year's digits (SID), allocate more depreciation expense in the earlier years of the asset's life. The key difference here is that accelerated methods reduce book value more quickly than straight-line methods, which can result in higher depreciation expenses in the short term but lower expenses in later years. 2. Expense impact on the income statement. Under the straight-line method, depreciation expense is constant each year, leading to predictable and steady impacts on the income statement. However, with accelerated depreciation, companies incur higher depreciation expenses in the early years of an asset's life, which reduces taxable income and can result in lower reported profits in those years. This can influence earnings per share, EPS, profitability ratios, and tax liabilities. The choice of method significantly affects a company's net income, especially in the short term. 3. Cash flow effects. Although depreciation is a non-cash expense, it impacts a company's cash flow through tax savings. Accelerated depreciation methods, by reducing taxable income earlier in the asset's life, can lead to higher tax savings in the initial years. This results in a temporary increase in cash flow during those years. On the other hand, the straight-line method spreads the tax benefits more evenly, which may result in lower cash flow in comparison during the initial years but more consistent benefits over time. 4. Asset value on the balance sheet. With straight-line depreciation, the reduction in asset value occurs gradually, resulting in a smoother and more stable decline in the asset's book value. This method ensures that the asset's value on the balance sheet is higher in earlier years compared to accelerated methods. In contrast, accelerated depreciation leads to a faster decrease in the asset's book value, causing the asset's value to decline sharply in the early years of its life. This can result in a lower book value, which may impact financial ratios like return on assets, ROA. 5. Impact on tax liabilities. The choice of depreciation method directly affects a company's tax obligations. With accelerated depreciation methods, businesses can reduce their taxable income more quickly, which leads to a lower tax bill in the early years of the asset's life. This is especially beneficial for businesses that want to retain more cash in the short term. Conversely, the straight-line method results in a more evenly distributed tax burden, with lower initial tax savings but more consistent tax deductions over time. 6. Impact on profitability ratios. The straight-line depreciation method produces a consistent depreciation expense, leading to a steady reduction in net income over the life of an asset. This provides predictable profitability ratios, such as net profit margin and return on equity. However, accelerated depreciation will result in lower profitability ratios in the initial years due to higher depreciation charges, which may artificially depress profits in the short term. Over time, as the depreciation expense decreases, these ratios can improve. 7. Use in financial planning and budgeting. When it comes to financial planning and budgeting, the choice of depreciation method can influence both long-term forecasts and short-term budgets. Straight-line depreciation offers more predictable and consistent budgeting, making it easier for businesses to forecast future expenses. In contrast, accelerated depreciation creates fluctuations in depreciation expenses, which can make budgeting more complex but may also allow businesses to account for the true wear and tear of high-use assets in the early years. 8. Implications for asset management. For businesses involved in industries with high capital expenditure or heavy machinery, the choice of depreciation method can affect their asset management strategies. Accelerated depreciation provides a more accurate reflection of the wear and tear on equipment used intensively in the short term. Straight-line depreciation, while simpler, may not fully capture the decline in value of assets that lose value more quickly. Companies that use accelerated depreciation might be better positioned to replace equipment sooner, as they write off more of the cost in the early years. 9. Investor perception and decision-making. Investors closely monitor depreciation methods, as they can have a significant impact on a company's reported profits and asset values. For example, a company that uses accelerated depreciation may appear less profitable in the short term, potentially making it less attractive to investors looking for consistent earnings. However, over time, as depreciation expenses decrease, the company might become more profitable. In contrast, straight-line depreciation offers a steadier view of profitability, which might appeal to investors looking for stability. 10. Accounting for impairment. When an asset's carrying value exceeds its recoverable amount, it must be written down through impairment accounting. Depreciation methods play a role in determining the book value of an asset and, consequently, the likelihood of an impairment charge. Since accelerated depreciation results in lower book values earlier on, an asset may reach its impairment threshold sooner compared to assets depreciated using the straight-line method, which maintains a higher book value over time. This difference can affect the frequency and magnitude of impairment charges recognized in financial statements. Choosing the right depreciation method is a crucial decision for businesses, as it has wide-ranging effects on financial statements, tax obligations, cash flow, and profitability. The primary differences between depreciation methods, straight line, double declining balance, and sum of the year's digits, affect how expenses are allocated over time, how assets are valued on the balance sheet, and how taxes are managed. Businesses need to carefully consider the impact of these methods not only on their internal financial reporting but also on investor perception, tax strategies, and long-term planning. By understanding the various depreciation methods and their financial implications, companies can make more informed decisions and optimize their financial performance over time.